Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here. Thanks for checking out the Private Lenders Podcast, sponsored by our mastermind group for private and hard money lenders. It is hardmoneymastermind.com. Go check it out, create a free account, take a look around. All right, so today we are talking about what we have learned from meeting with other local private lenders over the past 3 or so months. You might have heard us mention this before, either in the mastermind or in maybe some previous conversations on the podcast. But we made it a point to check in essence, with people that we have known for years now here in our home market. And that's like DC metro area, Baltimore area is where we started. We've expanded past that, but where we are physically based, our headquarters is in that area. So we met with 4 or 5 lenders over the past few months, and everyone runs their company a bit differently, right? In terms of the kinds of deals they do, how they underwrite, their source of capital. And it's been a very interesting experience to just see what everyone's been up to, because so many things changed, right? Like so many things in 2022 changed in the market in a number of different ways. And we just wanted to have some lunch, talk to people we've known for a while, and pick their brains about what's going on.
Yeah, and the interesting thing, it wasn't all that surprising based on who these lenders were. Some of them, had quite a bit of money, 20, 30, $40 million deployed of their own capital and private investors' capital. Some were smaller with just their own capital. Some of them were all institutional backed. They were doing lots of volume, but they were only institutional backed. We met with 2 of those lenders that originally, years back, they'd been around for a while. Years back, they had private capital in their own, but then they went the institutional capital route. They felt that was best for their business at the time, and they kind of went all in with that direction. But there was a few consensuses, I would say. If they have private capital available right now, they're in a very good spot. And if they didn't have private capital available right now, they're in a very poor spot. And I'll give you a few examples. So 2 of the particular lenders that we met with had a good operation at one point, but everything over the last 5-8 years has been institutional backed. The Pier Streets, the Rock, the Torax, Lima Ones, things like that. So they were used to using that capital for their deals. And for the most part, the capital has dried up a lot. And that's not to say that there's no capital available in that space, but it's limiting and it's expensive and it takes a long time. So it got to a point where they're really having a hard time, and they're reevaluating their entire business model to determine if it's even worth doing it this way. They're in the short term, what they're doing is they're trying to partner with companies like us and other hard money lenders to try to bring business to them just to get their clients serviced. Some deals they obviously would try to do through the institutional backed, but they had to make sure their clients were aware that, hey, we can go this route, but it's not going to be that much cheaper, and it's going to take a good bit of time. So we got to make sure this is what you want. So it's not that they're out of business. They just have, they had to pivot a little bit and kind of figure out what options that they had to make it work. And in the meantime, they're going back out to try to raise private capital from a core group of investors that they had, so they can be the private lender again.
Yeah. I mean, I think that's the takeaway number 1 would be, if you don't control your own capital, truly control it, then your business is very, very vulnerable, especially in times of change. That's when it happens. Like a lot of people who are putting out tons of volume over the past 5 years thought that it was always like that. And I'm not just talking about the people we met with. I'm talking about like in the industry nationwide, and the stuff that I see the conferences talking about and this and that they were under the impression that nothing was ever going to change. And if you're talking about institutional money, it could be a credit line from your local bank. It could be warehouse lines. It could be the secondary market where you're selling your loans off after you fund them to this company. All of that stuff changed dramatically. A couple of the people that we met with basically had their businesses gutted. They really did. And now they are pivoting, which is, kind of a nice way of saying that, like, they're trying to maintain some level of business, right, in the lending world. And also, on the other hand, the other important takeaway related to capital anyway, is that the people who are lending their own funds, like, start with some of those people, even if they're smaller, they're in a very good spot. They really are. They have their pick of deals, and things are looking fine. And then a lot of people are a mix. They have, like, their own, like us, like, we have our own funds out into deals, and we also have private capital investors who have been with us for well over a decade, many of them. And we, like, really control the situation in terms of all those individuals and the loans that we put out and everything else. The lenders that look like that are in a pretty good spot too. That's not to say that everything out there is super easy and rosy, and, like, everyone's keeping an eye on the real estate market, everyone's keeping an eye on the interest rate environment, and now, like, banks having trouble, stuff like that. This is all, tenuous sort of times that we're really keeping an eye on. But
yeah, go ahead.
No, I was done with that thought. Jump in.
And just because there's less capital available, and you can scoop in and do really good deals, probably better deals than you would have seen months ago, you still do have to be cautious. And we're all at the consensus. And again, who knows what's really going to happen, but we're at the consensus that the market's still fine. There's still a lot less inventory in the fix and flip play in the the investment residential space. There's less inventory, but at the same time, you still got to be smart. You don't know where the market's going to change. We're going to talk about what we've seen on some commercial deals here in a second. But on the residential side, there still seems to be good stuff. But remember, this is a great time. If you're used to giving 100% financing or 90% financing, this is a good time to cut it back to 80% financing or 70% financing, or something where your borrower is bringing more cash to the table. There's too many private lenders out there giving too much leverage, and that eventually is going to dry up and kick you in the butt, and you're going to take some major losses if that happens. So you got to be very, very careful. And this is a great time to do so, right? Like, hey, now borrowers are just happy that there is capital available for their deals. You don't have to compete with institutional backed capital. You don't have to compete with lots and lots of other lenders and capital in this space. So it's a good time to do that. And who knows what's going to happen in the market. I mean, I think all the lenders we met with, including ourselves, agree that the guarantors and the quality and the execution of the borrower is just very, very important. It's always been important in our minds, but I feel like there's a lot of lenders, including local lenders, that we knew that they were just more collateral based driven. And the collateral is obviously the number one backstop. It's the most important thing, but bad borrowers figure out a way to mess up good projects. And good borrowers figure out ways to always, make an okay deal into something good. So make sure you're pulling credit. Make sure you're doing whatever you can to determine the worthiness of the borrower. Meet with them, ideally in person. Worst case on Zoom, just to get a good gut feel from them. Meeting someone is important to do so. But I think the quality of the borrower is going to go a very, very long way. In now, and there's no need to do, lower quality deals. Do the best deals that you can get your hands on. And hopefully if you were lacking in deal flow over the last few months, hopefully without doing anything else, just by being present, the market has gifted you more opportunities. But don't stop marketing for opportunities, right? This is the time to continue to go all in and be present to get the best of the best deals and do the best deals that you have in front of you at any given time.
Yeah, that was another big takeaway for me from those handful of meetings and lunches, is that the lenders who stayed tight with their underwriting the collateral, underwriting the borrower, their portfolio's in a good spot. And some of the other people we met with who got too aggressive during that time are dealing with some real headaches and real estate owned, like, properties they've taken back because it was, all bad loans were made in good times, as they say, right? And a lot of people were getting too aggressive because the market was going up, and they felt like they had to compete with other lenders that were doing way too high leverage on stuff. And now they're feeling the pain of that. Some people are dealing with buybacks. which is not cool when you have already sold a loan and then now you have to come up with capital to buy it back from whoever you sold it to, which would be a nightmare. Or a private capital lender who just did a bad deal and took the property back, and now they have to deal with who knows what is owed on it versus what that asset is actually worth. Like, that came up in conversations too. And some people are fine because they stuck to their guns and their underwriting model. And some people, frankly, just got too aggressive. And, I'm going to emphasize the point that you made about how crucial marketing is to this. Again, people don't realize that marketing is going to end up determining the quality of your portfolio. They think it's just like for show. They think it's for, TikTok, or I want to be an influencer, or we like shooting videos. I don't really like doing any of that stuff. Right? Like, it's an important part of the business because it determines our lead flow, which determines the deals that we can do, which determines the quality and the performance of our portfolio. Right? So that's another huge takeaway, is like, marketing is going to determine what your business looks like. And people don't want to accept that. They think it's something you outsource, or that's not a big deal, or maybe you hire a part-time person, or it's like a little cherry on top of your lending operation. It's not a cherry on top. It's the freaking gasoline for the engine.
And if you're raising capital, or you have any type of capital investors behind you, if you don't have good opportunities, that capital's gone. Because you're going to have defaults, and you're going to have late pays, and you're going to have issues, and that capital is not going to stick by you on those things. You got to be very diligent about it. And good deals brings in good capital backings, good partnerships with capital sources. It's the only way to do it. It all starts on the front. Real quick, before we wrap up this episode, we're going to talk about some commercial stuff that we've seen, because I think that's kind of relevant. There's been a lot of interesting commercial assets that we've got looks at over the last few weeks and months and days, and deals that we probably would have thought were no-brainers 6 months ago, 3 months ago, that we're taking a second look at, and sometimes passing on, or giving lower than normal quotes on. And part of it's the market. Part of it's just like, when you look at enough deals, you kind of create an internal algorithm in your head of what's going on in the market. And I think that's important. And if you're only looking at a few deals a month, you're not going to have that. But if you're looking at lots of deals over and over and over, and you're getting looks from different angles, you'll be like, wait a second, there's a trend here, good or bad. And one of the trends has been office buildings, vacant office buildings that real estate investors and developers are buying at very, very good prices, and they need low LTV loans on, and we're still hesitant to do so. Because there's not a lot of liquidity in the marketplace for that. So that's one thing to point out, like retail and office. I'll give you an example. Like, we did a deal, and I think we've talked about this on maybe a previous podcast or last month's mastermind, but it was an 18-unit professional office building. In essence, they put 40% down, had high 700 credit scores, very qualified, and we did the deal. And in essence, we thought it was a home run at the time, and it's a very strong deal. But it's interesting because a lot of the banks still don't like professional offices. The problem with professional offices is the lease terms aren't all that long. Professional offices, they want 1 year leases, 2 year leases, 3 year leases, 5 year leases, no longer than 5 years leases. These smaller ones, $750 to $2,000 a month. If it was medical office, that would be a little bit different. You get longer term leases. If you have, a restaurant or like good retail, longer term retail with high TI and higher build outs, you can get longer term leases. But little professional offices, it was interesting. We learned something on that in real time, and it was quickly. And again, we feel it was a very strong loan that we did, and it cash flows. In essence, even at a 12.99% interest rate, it still covers cash flow. And they were strong guarantors. Their global cash flow is very high because they owned lots of other buildings free and clear. So in essence, that was fine. But we've thought through that as we underwrite some of these deals. We had a deal the other day that the borrower bought a property for $550. They were it was retail. They were going to move their owner operated market. They had like a Latin market that they operate. They were going to move it down the street into this building, but it was vacant currently at the time. And they wanted to put down 30-40%. And we were nervous that that wasn't enough. We ended up quoting them 200 on 550. And I know that kind of sounds crazy, but that's just what we were comfortable with. That's what we could wrap our brain around. in the present time. So don't be shy to quote whatever you're comfortable with. I think a deal like that we would have probably quoted 6 months ago or even longer. 300, 350, something like that, and we came in at 200. That's where we were at. So we're, just because there's a lot more opportunities and a lot of good looks, and don't get me wrong, we're doing them. All the good ones we can get our hands on, we're doing them. But we are kind of going through the motion and digging deep on some of these to make sure, there's exit strategies and things like that.
Yeah, it's been some interesting stuff that we're seeing. I think there is a lot of opportunity in small balance commercial, but you do have to be careful. You do have to be careful of the asset type, what you're getting into, being comfortable with valuations. But yeah, I mean, again, just like we started with, for the people who control private capital and know what they're doing in terms of underwriting, it's a good time to be a private lender for sure. And on that note, we have our Inner Circle meeting here in early May. It is sold out, completely booked. Our Inner Circle is currently full. To learn more and to get on the wait list, you can check out Hard Money Mastermind, innercircle.com. You can speak with Dave and talk about options for the future, but our May meeting is full. And besides that, if you haven't done so already, check out hardmoneymastermind.com to see what everyone else is doing on the online mastermind. And we will see you guys here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.